Here's why you cannot predict that stocks will go higher just because they've gone higher in the past, according to legendary investing professor Benjamin Graham. He explains that survivorship bias means that the performance of stock indexes ignores all of the companies that went bankrupt, got delisted, closed, or got acquired. In other words, indexes only show the companies that did well and stayed in the indexes, which skews the performance positively. Because of it, indexes wildly overstate the performance of real-life investors who were unable to know which companies were actually going to make it through. For example, even though the S&P 500 went up in 2023, everyone that owned shares of Silicon Valley Bank back in March got wiped out. The S&P 500 companies are not the same as they were 10 years ago. In fact, nearly a third of the index, or 180 companies, have been replaced since 2015. It reflects how fast-changing and innovative the economy is, and helps us understand that the performance of indexes is wildly different than even long-term individual stocks.